All right, this is the dollar index. The daily chart's on the left-hand side. As I mentioned last week, we traded up into this volume imbalance here, and we traded one more time into that, just breached the outside high end of it with the wick of the daily range. And I mentioned that there would be a likelihood of this down close candle and this up close candle becoming a inversion fair value gap. So we saw some sensitivity here last Friday, and it may need to come back down and retest that and trade into it. Now, since it's already responded on the upper quadrant of this SIBI, which we've looked at and anticipated as an inversion fair value gap that's bullish, the midpoint of this SIBI here, that red line here, price needs to only be in the upper half. Now it can touch the midpoint. It's better that it doesn't. And if it starts to resume going higher and attack these relative equal highs after it trades into the inversion fair value gap on the daily chart, that might be the fuel that's required for it to trade up into, say, this liquidity pool that's next on the daily chart. Overall, we're still inside of a large range, but I'm looking for signs that we've put an intermediate term low in. That's kind of like where we're at. A lot of wartime stuff on the news front. So it's going to be very knee-jerk reactionary type responses in dollar index going forward into the end of the year. So breaking it down on the 5-minute chart, you can see we worked up into that daily volume imbalance. This red area here is this area on the daily chart to the left. So you can see that little tiny little spike above on the daily chart. That's this here. And crossing over the midnight into today's trading on the 22nd of September, the market breaks down, creates a small little bearish fair value gap, rate and consequent encroachment of that daily volume imbalance. Note that. And you can see that it's respected that consequent encroachment with that bearish fair value gap. Market breaks down, another fair value gap there. And notice it doesn't get up into the volume imbalance when it trades up into these two candlestick wicks. So that bearish fair value gap here, it sends price lower, attacking the sell side in here, deeper than it did the first time. There's a small little shallow probe of it here. Market breaks lower, goes into another fair value gap there as well. And I'm looking at this across these two candlesticks here because this was actually shown as a single fair value gap on the 10-minute chart. So looking at that right there, I'm blending that. So that fair value gap there is a 10-minute. And it's just a matter of going through all the time frames. And I go through a myriad of different time frames. I don't just go to the static ones that everybody goes to. If there's a cluster or a consolidation of price action, I'll go down to every single 1-minute interval. So what I mean by that is 1 minute, 2 minute, 3 minute, 4 minute, 5, 6, 7, 8, 9, 10, 11, 12, and look for refinement in the inefficiency. And it's something that you should be doing. Now, when price is stretched out, like for instance, in this portion of the price run, you wouldn't need to do something like that because you can see it on 1 or 2 and it's obvious where the imbalance is. But the midpoint or consequent encroachment is being respected by the bodies here. We break lower, we have a volume imbalance. Market creates a consolidation here. It spikes up into that volume imbalance, lays a candlestick wick right in it perfectly, and then sells off, gravitating back towards this potential inversion fair value gap that might maybe lend to higher prices to take this out. Or if it fails, this is the point here. If it fails and trades through the midpoint here and gets down into the lower quadrant, the likelihood of bullishness evaporates considerably, meaning that we may have to revisit that low and go a little bit lower. So this is the catalyst or the line in the sand that determines for me what the next leg in price action. Right now, I'm going to stick with the likelihood of this potentially presenting itself as a bullish inversion fair value gap. Maybe the market trades lower during the London kill zone at 5 a.m. Then we have a little consolidation. It rolls over a little bit lower, and we pick it back up at 7 o'clock in the morning, which is the New York kill zone. Trades into a bearish fair value gap there. Trades lower, right back into it once more to attack the relative equal lows where there's sell side there. Then we have a New York session reversal, trading back up and leaving these relative equal highs here. Breaks lower, small little inefficiency in there. I didn't draw. And then we went lower once more. And it looks like it wants to dig into this daily potential bullish inversion fair value gap. And again, that's this area here, which I stated would likely be an interest of mine should we go higher when we were trading on that day. And then we went through it. So the next day on Friday, we opened, traded down into the upper quadrant, which is this line here, and then sent us up into the daily volume imbalance. And once we got there, we're pulling back down lower in the attempt maybe to see this act as a discount array to send it one more time higher. All right, the euro dollar daily chart on the left. I mentioned this inefficiency in the last passing of my commentary on euro, and the bodies have perfectly respected that inefficiency while allowing the wicks to do the damage. So notice how we saw today trade below Friday's low. We traded into that. I'm going to counsel you to add the gradient levels on this discount wick, and you'll see something in here that I'm not showing you here, not because I want to hide it from you, but I like to leave little things in here for you to find on your own. And the bodies respect that bullish fair value gap, and it rallies back up into this inefficiency that's shaded in yellow. This is a buy side balance, sell side inefficiency, but now we went below it. So trading up to the midpoint, it would be bullish and continuous bullish if it goes above it and then trades as an inversion pair. I'm sorry, not inversion pair gap. It reclaimed bullish fair value gap in this yellow area. On the London kill zone, we see a breakaway gap here. Never trades back down into it. Immediate rebalance here. I don't want to annotate here because it's getting busy with a lot of annotations. You can add that to your own. Bullish fair value gap there. And we have the market trade back down into another bullish fair value gap as well. And that's actually an order block too, but I didn't want to add it because it's too many annotations. You can add it for yours. That's what I'm counseling you to do. Then we have this low, this high, and that lower low. So that's a bullish breaker. And we have the order block, which is the 2 consecutive down close candles. And that's a change in state of delivery. Bullish. So we hit that. And also we're hitting the low of that fair value gap on the daily chart. We're seeing a hit here. So this green box area here during the kill zone is basically touching right there on the daily chart. And then we see the extrapolation to the upside, a institutional ortho entry drill here. Fair value gap that doesn't get filled just by one tick. It trades below the high of it. And then the consolidation here rips through it, trades up into the lower quadrant level at 1.17829. And that's this level here, the lower quadrant of this old bullish fair value gap. And we had multiple attempts in here to kill zone during the New York Open. And we break lower to clear up the sell side here. And then it springs higher after creating a fair value gap and trading into a propulsion block. This is the order block here, but then this candle is higher, trades down to halfway, but doesn't close below the halfway. And that's a definition for propulsion block. And then market springs through and gets up to the consequent encroachment, making the higher high, which is the consequent encroachment of this old buy side and balance, sell side efficiency fair value gap. All right, here's the British pound or cable daily chart left-hand side. I mentioned on Friday we traded down to this bullish fair value gap, and the bodies were respecting consequent encroachment. That's the midpoint of that after taking out Friday's low. So we have this wick here. Whether we're bullish or bearish, the market will want to go back up into this wick and maybe even trade back up into this area here. So this discount wick. Bullish or bearish, it doesn't matter. I always look for price to try to gravitate back into these. Now, if I'm bullish, I want to see it trade into the upper quadrants. If I'm bearish, I want to see it find resistance in the lower half of these discount wicks. Okay. So over here we have the London kill zone, the breakaway gap again, like on fiber. We have an institutional ortho entry drill, which is this candlestick. We trade one tick below the previous candle and leave the gap open. Then we have a fair value gap there, and it's also occurring right at the consequent encroachment of this bullish fair value gap. See the red line? That price right there is this price. So the market hits that. And we also have a fair value gap and a order block, which is change state delivery. It wicks through it just to tap the fair value gap and the consequent encroachment. There's times when my PD arrays will just allow the market to color outside the lines. When there's a confluence of PD arrays, that's why it's doing that little coloring outside the lines. It's not randomness. It's the fact that it's going to these more significant PD arrays that's in line with what the present narrative is. So if the market's bullish, it's going to really come down here and offer the opportunity, if it's in close proximity, whatever the lowest PD array is in that cluster of price action, it'll reach for that one like it does here with the fair value gap. And the bodies are respecting that bullish fair value gap here and sends it higher. Once more, accumulates around the upper quadrant of that old bullish fair value gap. That's level here. And springs out of that, comes back down in. It's the low of the sell side liquidity pool. That's this low right here. Okay. So it sweeps the liquidity below that low here, once more here, once more here, and look at the bodies respecting it here, and then sends it higher, accumulates around the lower quadrant of this wick right here. This is September 11th. and then the market runs higher, comes back to the lower quadrant, and then this is the high of that September 11th daily discount wick. That's the open of this candlestick, basically. So this wick is below the candlestick, so it's a discount wick, and it's the high of it. That's this level right here, and it trades right up into that. So we're going to see what we see in regards to continuation. Should cable go higher, this is the present sell side imbalance that's trading into. And if we get above this high here, what I want to see is how we trade to, if at all, if we even get to the midpoint of that. If it's bullish, it'll have no problem getting up to the midpoint and go higher. If it's bearish, it may falter and roll over before getting here, or it needs to trade to the upper, not the upper, but the lower quadrant level here, or this level and fail, and then roll over. That would be indicative of weakness. Right on the left-hand side, we have the December contract Christmas NQ daily chart, and on the right-hand side, it's the 5-minute chart. As I mentioned, we worked off this volume imbalance and really had a nice run up here last week. Friday, we used the volume imbalance, as I mentioned in the recording for Friday. And I told you to have these quadrant levels on your chart. And the market opened below, and we're going to look at the opening range in the next slide here, but we opened lower than where we closed on Friday. We traded lower down into consequent encouragement, went just a little bit below it, and then rejected all of that and came out and exploded to all-time highs above 25,000. But over here on the London session, London kill zone here between 1 o'clock and 5 a.m., we have a nice fair value gap here. It drops down into the consequent encroachment of that premium wick. So it's going to act as a discount array here. And notice it goes down in the lower half of it, but it doesn't spend much time there. It just goes below here, accumulates at the consequent encroachment level there, and now look what it's doing. It fails to touch it again and then rallies up. Shift in market structure, bullish fair value gap, now during the New York AM session. Now I'm saying that because it's basically 7 a.m. to 11 a.m. You can break that up into pre-market session or the AM session, regular trading hours at 9:30 to 11. Okay, that I'm just encapsulating this just for brevity's sake. And we have a bullish fair value gap here. Trades into that perfectly, runs higher. We have essentially a measuring gap. So if you look at the low to that gap there, it's about halfway between there and there. So between here and here, that's in close proximity to where a halfway point would be. And then we have a fair value gap that stays open, rallies off of that. Bullish order block, change in state of delivery after a retracement. The body's respecting that, and then rallies higher, creating an amazing, in my opinion, run above the 25,000 mark. Now, if we look at this through the lens of a 1 minute, we can see that we had relatively equal lows here in Friday's session, and we're looking at regular trading hours now, not electronic trading hours. So this will showcase the difference between previous day's close and today's regular session opening at 9:30 Eastern time. So sell side liquidity here. The market opens below that. The opening range here, the first 30 minutes of trading, is encapsulated with this darker gray box, and I've graded that as well. So here's the lower quadrant, consequent encroachment, upper quadrant. The market opening here trades up to consequent encroachment, which is 70% likelihood it's going to do that. There's a gap lower, and then we trade right up to the upper quadrant rather, hits it perfectly to the tick, and then drops back down to the lower quadrant. The body's respected, but it also trades one more time into this relatively low liquidity pool. Tags that one more time, breakaway gap. Trades above short-term highs. We have a bullish fair value gap there and a minor sell side liquidity pool after trading to last Friday's high, but not breaching it. Trades lower, swipes the minor sell side that would have been trailed on longs, trading into the bullish fair value gap there. Then we have another run higher, shift in market structure on the lower time frame here. Bullish fair value gap, trades still here, and notice it doesn't even trade to consequent encroachment, but reverses its role in delivering lower prices now back in sync with going higher. Rips above last Friday's daily high, buy side liquidity pool, and then creates a retracement in here. We're going to look at when we scrub the chart over a little bit, but notice this box in here. This is all going to be condensed and shortened in size as I move forward into the chart. Here's that area I was referring to. Now we get to see the entirety of the day at the time of the snapshot. Those are those highs for last Friday's daily high. Supply side liquidity pool hits it. It drops down, which is a 5-minute bullish order block. So I showed you a 5-minute chart first. That's this order block there. So it's going to look different because you're looking at it through the lens of a 1-minute chart. So when you're annotating your charts, make sure you're keeping track of what PD array you're annotating on a higher time frame when you drop down a lower time frame, because this is going to be much more salient when you view it from that 5-minute chart again. Then we rally higher, and this keeps on pressing higher. Notice there's no lunchtime macro, no retracement back to here's 10 a.m. Find a low. Here's that one, and we have this one here to noon. Well, neither one of those were even traded to because we're blasting off. The market's becoming parabolic. So when it starts to do things like this, I'm not calling a top. It just means that we're probably near some kind of an intermediate term high forming. I don't believe it's there yet, but it's showing characteristics of it possibly, forming maybe this week.